All right, everybody, welcome back to our trainings. Today is September 1st, 2022. And man alive, this is episode 3 of our daily trainings. We're so excited. We're going to just continue on with our training. Those of you that are going to be following this training, you can go episode to episode, back to back, or you could pick and choose what episodes you want to jump around in. I want to back up really quick from yesterday, and I want to talk about one of the things we did. We did life commissions yesterday, and we talked about how you get a percentage. These are the percentages of the annual premium. We talked about monthly premium, annual premium, and what percentage. So anytime you talk about percentages of commission, you have to ask yourself percentages of what, right? The other thing I want to talk about when it comes to this is chargebacks. If you remember, we talked about how they advance us 9 months worth of commissions up front. So the company receives only 1 month, $84 in this case, 1 month's premium, and they turn around and they advance us 9 months or 75% of the entire year of the annual commission. So what happens if the client cancels their policy? Now, let me change my camera situation because I want y'all to look at me, right? Look at me. Put that camera on me, like Art Williams used to say. So here's the deal. First of all, you got to be careful as you're writing your lifestyle. You don't want a lifestyle to charge back. The only reason a chargeback should occur is if we were not careful, we didn't ask the medical questions properly, the client has some kind of a medical issue that they're not aware of. Sometimes that comes out during the process of underwriting, people, and which is good in a way because people didn't know that they had some kind of medical issue. And because of our underwriting, they become aware of it, then they can go do something about it. But the fact remains that sale doesn't go through and it charges back. There might be some relationship issues. There might be some marital problems that maybe you didn't pick up when you were talking to the husband and wife or the partners. And then later on, that issue comes to the surface. That, of course, that has nothing to do with us, but the fact that there might be a separation or divorce. And sometimes people say, well, I'm going to cancel that policy or whatever. So there are circumstances beyond our control where a policy can cancel down the line. And especially if it canceled within those 9 months, because you already got commission, you already received the commission for the first 9 months. So let's simplify this. As long as the client keeps that policy for those 9 months that you got paid for, then you're even Steven as far as commissions are concerned. Now, there's other issues with cancellations, and we'll talk about that on a different episode. But right now, understand that you got paid for 9 months. The client kept their policy for at least 9 months, and they paid for it. And let's say if they cancel, in the 10th month, then nothing venture, nothing. In other words, you're right there. You got paid already, and they canceled, so you're not going to get paid the months of 10, 11, and 12. I'm oversimplifying this right now, but you start to understand how chargebacks work. You got paid for 9 months and the client cancels after 3 months. Well, you earned those 3 months, but you have to return the 6 months of commission that you didn't earn. We talk about this. Insurance companies are run by very intelligent people, by very smart people. And these people, if they don't receive the money from the client, why should they pay the commission on that product? Does that make sense? Think about it. If you purchase a pair of shoes from a place and then you take it back the next day and you return it, they're going to give you your money back. Okay, that's a chargeback. Okay, that just happens. That's just the way it is in the business world. And nobody wants to think that, hey, if I buy these pair of shoes, that's it. I'm stuck with them. I can never return them. If I don't like them, I have to just throw them out or give them to charity or something. Nobody wants to think that. So we believe that, hey, I can go and return the shoes simply because I didn't like it. But in our business, if they cancel the policy, and like I said, we're going to talk extensively about the things you can do to prevent policies from canceling down the line. And you got to put in some work into that. Both at the time you're writing the sale, you're taking the application, and then later on through customer service and through the proper follow-up, you can minimize or pretty much avoid cancellations, except, like I said, due to cases where it's completely out of anybody's control. Outside of those cases, you can control the amount of chargebacks. But if they do occur, if the chargebacks do occur, you got to pay for 9 months, the client keeps it for 3 months, you have to pay back a 6 months. You got to pay for 9 months, the client keeps it for 8 months. You have to pay back the 1 month that you never earned because it was an advance. It was really a loan. It was an interest-free loan that the company gave you. So how do they handle chargebacks? Well, I mean, realistically, that money doesn't belong to us. We never earned it. We have to pay that back. But the company is very patient. They'll say, okay, go ahead and write your next sale, your next transaction, and we'll deduct the portion that you owe us back. We'll go ahead and deduct that from the next sale. So that's really, perfectly good, unless somebody is just writing a large number of really bad sales, and people do that. But again, we'll talk about the psychology of that, why people do stuff like that, how to prevent that in a later episode. But if somebody writes a lot of bad business and then they can't replace all those chargebacks with new sales, then the company expects, they'll wait a certain period of time, they'll send you letters, they'll ask you to, hey, come on, you got to pay this stuff back to us. Either we'll go right into more sales, or at some point, you're just going to have to pay the money back. It's just, that's money you owe. That's a loan that you got. And so make sure you understand the concept of chargeback and the reason behind chargeback. People always go, well, is there chargebacks? Well, in business, anytime the client is not satisfied for whatever reason and they return the merchandise, they're going to get their money back. In the example of the shoes, you return the pair of shoes. Not only the company made no money, that shoe store made no money from the shoes, but potentially there's some marks on the shoes now, or there might be a scuff mark, there might be something there. And they might not even be able to sell those shoes again, or they might have to put it on the discount rack or something because of that reason. So they're going to take a loss on that. And this is just part and parcel of business and just price of doing business. Sometimes you just have to accept those chargebacks. So I wanted to cover that because yesterday we did a pretty extensive coverage of commissions and how they're paid and so on and so forth, and where to find commissions online and where to find the percentages and all that. Okay, now I'm going to take you guys now to let's go ahead and take us to back here. Let's see. I'm going to go over here. All right, and I'm going to close this one. Actually, I'm just going to open up. All right, let's see. I must have closed that already. That's okay. All right, let's go over here and we'll just open up a brand new. All right, I want to make sure that you guys are seeing what I'm seeing really quick. And the only way I can do that is to monitor. Here we go. Okay, perfect. All right, so that's POL. So we're going to log into POL. Okay. And okay, so check this out. Look at where I'm going to go now. I'm going to go over here under products. Okay, products right here. See that drop down menu. Now, yesterday we talked about life insurance commissions, and the way I got to it right here from the front page, and I just went to compensation. I just jumped down to compensation. The other way to do it is you go to products and you go to life insurance, and then through there, you just go down here a little bit, and you'll see everything. For example, right there, you can see, let's see, underwriting, quality of business, marketing, training, products, and up here, right here, field comp. See that right there on the right-hand side? So you can look at compensation that way. But today I want to talk about a different product. I want to talk about securities and investments. So watch, we're going to click on investments now, which is again under that tab of products here on the right-hand side, investments. Then I'm going to jump over here and I'm going to click on United States, right? Because we're obviously in the United States and in Canada, and they have a completely different set of rules up there. United States, I clicked on that. And then I'm going to scroll down, as you guys can see. Okay, see that on the left side? I'm scrolling down, and then I'm going to come down here to what it says commission schedule right there. I'm going to pause until Zoom catches up. All right, right there, commission schedule. I'm going to click on that. Now over here, you've got all different kinds of commissions that you can see on all different types of investment products. We have our straight out mutual funds, our managed accounts, our any kind of qualified retirement plans that we can go in and set up for companies, things like 401k. So, well, how do we get paid on that? Right? And on those great questions. Next line, you've got annuities. And then we offer annuities through different companies, through Lincoln Financial Group, through Bright House, through Equitable. You have your variable annuities, your fixed annuities. You have, again, Lincoln, Bright House, AIG. They offer a fixed annuity that we offer through them, and so on and so on and so forth. So there's all of these different products. I'm gonna focus on two things today. The first thing I'm going to talk about briefly is I'm going to talk about the commission on variable annuities. All right. And then I'm not going to focus too much on that because variable annuities pay a slightly higher commission. And instead of doing all my math and all my numbers based on higher commissions, I'd rather do it on the lower commissions so we're not exaggerating, right? I always like to keep things on the low end and give you the worst case scenario on something. And then you guys can say, well, there's always, you could always get better from it. So you understand how to do it. I just clicked on the variable annuity little link, and you notice that there's a commission schedule. Remember yesterday we talked about the life commission schedule? Well, here is the securities commission schedule. I hope you guys can see that. So it goes from 30% to 62%. Of course, there's overrides, there's everything just like it works in the life side of our business. So a rep makes 30%, a district leader makes 35%, a regional leader makes 42.5%, and RVP makes 60%. Now, again, the question is of what? Of what, right? That, we always give you a percentage, we give you the commission, and then we have to explain how that commission is calculated and what is it based on. So I'm going to scroll down here. So in fact, I'm going to write this down and I'll show you later. So district, I'm going to write it down. It's 35%, and an RVP, write that down, is 62%. And you could of course look at all of them. Now I'm going to scroll down, and show you another small little table. And this shows the product commission that the company receives from the, from the variable annuity company. So if the age of the client is less than 81 years old, our company receives a 5% commission, 5% straight out commission based on the amount of money that goes in. And there's other limitations too, but we're just going to look at general. If the client is older, between 81 and 85, it's 2.5%. And if the client is over 86 years, and by the way, the reason they use such high ages is because typically annuity clients are older. They're more established in life. They have more money. They're looking at their money differently. They're looking for certain guarantees in their money that possibly a regular investment may or may not offer. And, again, we're not getting into the specifics of these products. We're just looking at the commission right now. So let's look at the 5%. So I'm going to switch gears here real quick. I'm going to stop sharing, and I'm going to go to over here. So to the 5%. So as you guys can see my camera. So these are the commissions of the variable annuity. And remember, the overall commission that the company receives is 5%. So a district makes 35% of the 5%, and the regional vice president makes 62% of the 5%. So if you do the math, I'm going to get out my calculator, my handy dandy little calculator real quick, and I'm going to figure out 35% of 5%. I know it's a little bit confusing, but a district leader makes 1.75% of the overall investment. So it's 35% of that amount. An RVP, I'm going to figure out 62% of 5%, receives 3.1% of the overall amount. So really quickly, very, very elegantly, very, very just in general, if a client invests $100,000, okay, into a variable annuity that you are offering them, a district leader will make $1,750. And that's 1.75% of 100,000. An RVP would make $3,100. That's 33.1% of 100,000. If you want to do it based on $10,000, that's okay too. That's $175 and $310. Okay, So, it's the easiest money you ever made. It's the simplest money. Obviously, you have to know what you're talking about. You have to have the proper licensure and all that. So the reason I did the variable annuities, again, is two reasons. One is it's slightly higher amount, a little bit different than, okay. And also it's straightforward. In other words, it does not depend on the dollar amount of the investment. It's pretty straightforward. And you can, if somebody puts $1 million, it's 17,000 and 31,000 and so on and so on. It doesn't vary. Okay. Now let me stop my sharing over here. No, I need to change screens real quick and go to my camera. Okay. Now I'm going to go back to where we were, which is right over here. And just to make sure, I'm going to open up my phone here again, just to make sure you guys are seeing what I'm seeing. Okay, good. Now, let's go back to, again, products, investments. So remember, this is where we get all our general information when we go to United States. And I'm going to go down to commissions schedule. Now, this time I'm going to look at mutual funds. All right, so let's take a look at mutual funds. So on this page, you can see there's your commission structure. There it is. These are pretty straightforward. All right, now on the right, you can see what they call trail. And we'll talk about trails. We'll touch on trails very briefly later on. But I just want you to look at the original commission. This is the commission that you make on the money that comes in the door, okay? So again, if you get $100 mutual fund investment or get $1,000 or $10,000. Now, in mutual funds, it does matter the quantity, okay? So, or excuse me, the dollar amount. So let's go down here. And again, you guys can pull this up and read it, but I'm kind of showing you guys the highlights. So take a look here. So if the amount that the client is investing is between, let's say, $1 and $25,000. Now we don't take a $1 investment, but you understand. Okay, and if it's an equity fund, or if it's a taxable fixed income fund, or it's a muni bond, a municipal bond, that is what's called the dealer reallowance, or what I call the commission that our company receives from the mutual fund company. So again, you can see it starts right at 5% again, right? But as you can see, there's breakpoints. So if the client is investing over 25,000, it drops down to 4.5, and 4, then to 3, 2.5, 1.8, 1.2, and anything over $1 million, the company receives a 1% commission, and then we receive a percentage of that. So you understand, there's the company commission, which is called a dealer reallowance, and there's this number right here. So I'm gonna keep this screen open, and I'm gonna show you a couple of things. So some of the calculation I'm going to show you later is going to show a 3%, and the reason it's 3%, it's right there in the middle. It's not the lowest, it's not the highest, so it just kind of shows the average over the years. Oh, by the way, another question might come up: that what if the client starts out small and then their investments start to grow over the years? Well, once they pass a certain break point, of course they're going to get charged a lower commission. They're going to charge a lower fee. The company gets a lower commission, and we get a slightly, but then it's on a larger amount. You understand? So there's that. There's also what's called, again, I don't want to get into investment and securities trading here, but there's a thing called letter of intent, or LOI. And based on the LOI that the client signs, if they say, well, wait a minute, I'm going to put a little bit now, but I'm going to put a lot more later on this year, the client can get the lower commission rate up front. And if they don't satisfy that, then they'll go back and recalculate. All right, but anyways, again, and there's just too many moving parts, and I don't want to confuse it. So you're going to notice that I'm going to use this 3% here, and you're also going to notice that I'm going to use the 5%. So those are the two numbers that I'm going to use, the 5% and the 3%. Okay, so let's move on over here, and let's take a look. So I'm going to switch. By the way, we need this table, so so remember this table right here. District makes 35% again. And an RVP, and again, you could look at a regional leader, 42.5, whatever. I'm just going to use those two examples. And RVP makes 62%. So I'm going to write that down. And coincidentally, those happen to be the same exact percentages of the dealer reallowance as variable annuities, except in variable annuities, as I said, it's straight across. There's no breakpoints, but in the mutual funds there is. All right, so keep all that in mind. All right, all right, all right. And then the 3 and the 5%, remember that. So I'm going to stop sharing here. All right, now let's move on to, let's go back to our little handy dandy little camera over here, our IPEVO. Remember that? IPEVO. You might want to get yourself one of these. So this is for mutual funds. Okay. We talked about that earlier. And then we said either based on 5% or 3%. And you understand why I selected those two numbers, right? Okay, beautiful. Now, so I'm gonna, again, switch screens here and go back to my camera. And, oh no, wrong camera. Sorry about that. All right, now I'm gonna share my screen. I'm gonna show you guys this whole thing right here. Okay, so let's use an example of, okay, for those of you that are not familiar with the term IRA, that stands for Individual Retirement Account. And right now, this year, now it's going to change next year and the following, some of these years, it's going to go up to as high as 7,500. But this year, an individual is allowed to put up to $6,000 into their own individual retirement account. If you do that, if you calculate that based on monthly, that's $500 a month that a person can put into an IRA. Again, this is not a discussion about how IRAs work and different kinds of IRAs and all that. I'm just focusing on the commission right now. So a person could put up to, they don't have to put the $500 a month. They can put 100 a month. They can put 50 a month. They could put 200 a month, whatever they can, but they can put a maximum amount of $500. And of course, there are a lot of benefits to that. So if you have two people in a household, you have a mom and a dad, or husband and wife, or two partners that are saying, okay, we're going to both max out our retirement plans. Okay, so I'm going to put 500. My partner's going to put 500. That's $1,000 that's being invested in that household. So far, so good. Now, let's say that we call it a family unit, and then let's say that family that you are helping one family per week. Not one a day, not 10 a day, one a week. So in a 7-day period, all you're doing is you're finding one client, or you're going to a person saying, hey, listen, do you have your retirement plan set up? Are you good to go? Why don't we take a look at your retirement? It's gonna come fast, sooner than you think, and all that. And so if you're helping one family a week, in a month, you have helped 4 families, and that's $4,000 of investments that's coming in at the end of the first month. At the end of the second month, those first 4 families are still going to put in their $1,000 a month, right? And now you got 4 new families. So now you're up to $8,000 a month in the second month. Okay, does that make sense, you guys? Third month is $12,000. Fourth month is $16,000 a month that's coming into your investments. All right, so let's take that one step further. By the end of the first year, you have $48,000 a month coming into your, what we call, assets under management, or AUMs. Okay, so that's $48,000 a month coming in, just month in, month out. But then again, the next month, so after the first year and 1 month, now you got 48,000 plus another 4,000, 52,000, and so right, you get the picture. Now, at the end of the 10 years, now hold on a minute. Let me get that camera back on me, right? Look, I'm talking to you guys like business owners. I'm not talking to you guys like, you get bored 3 seconds later and you've already, like squirrel, you've already lost, we've lost you, your attention's on to something else. You're selling some kind of juice or vitamin or whatever. I'm talking to you guys as business owners, as somebody that comes in and understands to build a business. You're going to have to, think long term. So I'm only talking to those of you that are interested in building a solid foundation and a strong business. So that's why I'm talking 10 years, 20 years, right? So at the end of the 10th year, you have nearly $500,000 coming in every month. And by the end of the 20th year, so I've been here 29 years already. You understand, right? So, time flies. It's going to go like that. But by the end of the 20th year, you have nearly $1 million a month. See, here's what Here's the problem. Everybody's looking for that $1 million investment. They're looking for these whale clients with lots of money. But see, I'm not that good. I'm not that smart. I'm like, I'm just going to do one little thing a week. Remember, this is all based on one transaction per week. One single solitaire. Obviously, you're going to have to make some phone calls and, get some referrals and do this and do that. But if you're interested in building your securities business, think of how many thousands of clients we deal with in our hierarchy. And every single one of them should have a conversation with them like, let's make sure that your retirement plan is, so this is just retirement. We're not talking kids' college funds. We're not talking about short-term funds. We're not talking about emergency funds. We're not talking about any of that stuff. We're only talking about the one thing right now. So at the end of 20 years, you've got nearly $1 million coming in. All right. Now let me take your attention. So let me take you back to, remember, a district leader makes 35% of 5%. And so let's take a look at that. All right. Let's take a look at that. A district leader. Yes. Look at that. A district leader at the end of in 20 years, just doing a little bit of time, working part-time, working their job, having a little side hustle, a little bit over here, a little bit over here, one client a week. They're now making over $16,000 per month, And a regional vice president who did nothing other than get one client is now making nearly $30,000. That's $29,760 to be exact. How did I calculate that? Let me show you. So let me stop my sharing. Let's switch cameras over here. All right, let's go back over here. So remember, this was our commission, remember? So what is 35% of 5%? That is 1.75%. So what is 1.75% of $960,000? You could do the math on that yourself. It's just multiply it out. It's exactly that, whatever 16,000 or whatever that I was talking about earlier. I'll look it up and I'll just tell it to you. Where is that sucker? Right there. Okay, it's $16,800. This is monthly income. Okay, so what is RVPs was what? Was 3.1%. Remember, it's very similar to what we did earlier. What's 3.1% of $960,000? That is the figure I gave you guys earlier, which is $29,760. This is how much? This is annual? No, this is monthly income. Now, listen to this. Pay attention. If I do, this was for 20 years. If you do 10, at the end of the 10th year, you're making $8,400 a month. An RVP at the end of the 10th year is making whatever half of that is, about $15,000 a month. Let's take it into 5 years. At the end of 5 years, you're making 1/4 of that, right? So you're making about $4,200 a month. And you're not lifting a finger. Not a finger is being lifted, nothing. You're just doing some maintenance. You're calling your clients from time to time. The company has got an incredible, what they call CRM, customer relations manager, that sends out birthday greetings and holiday greetings and just kind of keeps in touch with the client. They do it for you. They do it on your behalf. It's incredible. So the company's got all these technology things working for us because remember, we're number one in innovation in the industry. I know other companies do them as well, but the way we do it, how we do it, the way our app works, it's unstinking believable. So at the end of 5 years, you're already making about $4 grand a month in securities income. And again, keep in mind, all I did, let me change my cameras here back. Okay, remember, all I did is I said, let me just go do one thing a week. Now, don't forget, we're recruiting, we're building. I'm not even talking about the money that you're going to make from your business. I'm not talking about how many people you're going to get life licenses. We're not even touching the life commission today. Today, we're focusing strictly on one thing, on helping one family a week. See, there's such amount of mass misinformation out there. One of the things that kills me is people talking about how difficult the securities license is. You got to stop listening to those people. If I swear to God, if you dare say that in front of me, I'm going to ask you to leave our office and leave our business. That you went up to somebody and you told them how difficult it was and how you took it 18 times and you couldn't pass it. Hey, stop talking about that. Stop putting the fear into people. The number one reason people are so afraid and so fearful of taking the securities exam is because of what all the naysayers and all the negs, all the negative people, because of what they're saying. If you study, you'll pass. If you don't, you won't. It's really, really, really that simple. I don't want to hear another word about this. If your life depended on it, you would pass that securities test. If I took something near and dear to you and I said something or someone, I said, you're never going to see this thing or this person ever again until you would pass your securities exam like that. Don't tell me, see, because maybe you didn't take it seriously. Maybe you gave in and you already listened to all the naysayers, all the negative people, the people that don't want to win themselves, and they'll be darned if they're going to see you win. They'll be darned if they're going to see you win. So they're going to come and say, hey, that test was so hard. I took it 35,000 times and I didn't pass. Don't you dare say that in front of me. Don't let me hear you say that, because everyone can pass their securities exam if they bear down and they study and they do what they're supposed to do. Everybody can do it. Okay, you got to get that license. So does that make sense, y'all? All right, let me show you one other thing here. Okay, I'm going to get off my soapbox here right now. I'm going to share another screen with you guys. Okay, right here. Nope, that I just already talked about that one. Let's see, share screen, and I think there it is. There it is. Okay. And I'm going to jump over here. Yeah, you guys can see that. I'm going to show you guys this little thing here. Okay, so watch this. This one I stole from my friend Tom. I mean, he didn't steal it. He gave it to me. But I'm going to show you guys something real quick. What he calls the power of seeing 32. Now, I already Alexized this. We have the rule of 72. Well, I call this a rule of 32. Right? Tom's like, Alex, don't change my things around, right? And so the rule of 32, the power of seeing. Now, you're not going to see 32 people in a day. You're not going to see 32 people in a week. You might see 32 people in a month if you're busy, if you're full-time, and if you're seeing one client a day, or not client, but you're attempting to take somebody, one person a day and convert them into your client. Let me show you the power in them. Here's what Tom, and because he's one of the top securities producers in the company, here's what he's found out just through sheer repetition and through just knowledge and just doing this for years. He found out that out of every 32, he looked at all the stats of everything he's done for decades now. And he found out that of every 32 clients between ages of 30 and 55, one of them is going to have $300,000 or more to invest. How's that, right? And 3 of those, 1 in 3 is going to have 30,000. So let me ask you guys a question, I don't know what happened here. I think it's just, okay, there it is. It's coming back. So let me ask you guys a question. Which are better odds, would you say? 1 in 32 success rate or 1 in 30 success rate? Well, the answer is obvious. Excuse me, 1 in 3. Okay, I don't know why, I guess PowerPoint's having some issues. But 1 in 3 is a better odds than 1 in 32. Now, I'm not saying, look, you're going to get some big securities sales. You're going to get some big chunks coming in once you get your confidence up and your competence up. But let me tell you something. There's 2 things. One is the more of these little 30,000s, and again, these are all averages. You might get 10,000, 5,000, 40,000, 50,000. It is so much easier to sit down with a client who has 30,000 and quickly move that 30,000 over and then help them and show them and educate them and then go to the next client and do another average of 30,000. It is so much easier and so much quicker. And when you do plenty of these 30,000s, again, you gain more confidence and you gain more confidence. One thing I heard and I learned years ago is that to be able to get large investments, you have to have the gumption, you have to have the guts to ask for that. It's not the only thing you have to have. You have to have knowledge, experience. You have to have some gravitas. Your name gets out there. People talk to each other like, hey, this person's a good investment person. Talk to them, all that stuff. So that's fantastic. But to get to that point, you do a bunch of $30,000, $10,000, $20,000, and clients that give you those 30,000. They're grateful. They don't control your business. You understand? They're not doing you a favor. You are doing them a favor. Okay, now hold on. Now stay with me on this. You might want to watch this video over and over again to understand psychology behind this, because this is so stinking important. Okay, here's another thing. Remember those break points we talked about? Remember the break points? Guess what? The break point on a $300,000 investment is a higher break point, meaning it's a lower commission rate. Yes, it's a bigger dollar amount. But if you do, watch this. If you do one $300,000 investment versus 10 $30,000, it's the same. It looks like it's the same 30,000. It's the same 300,000, but it's not. That 300,000 and that 300,000 are different 300,000. And again, I'm only talking to you guys in terms of commission. Again, there's so much more to talk about. But if you say, Alex, would you rather take one $300,000 investment or 10 $30,000? One side of me says, well, yeah, it's a bigger amount, blah, 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 all that. It's quicker. But another side of me says, that 30,000, 10 of them, I look at the difference. Now, we already covered the commission. Remember, district makes 35% of 5%, right? And because it's a lower break point, it's 5%. And the other one's a higher break point. They make 35% of 3%. Remember, we talked about this already. Because it's in a higher, it might be a 2%. I forget exactly at 300,000 where it is. We can look it up real quick. But you understand what I'm talking about, right? This thing's going to keep resetting for some reason, but that's okay. We're not going to get distracted. We're going to keep talking about this. So that 300,000 and the other 300,000 are different 300,000s. Are you with me on this? Okay, so let's keep going. Oh boy, here we go. Just going to keep doing this and doing this. All right. So the goal is to see 32 people, whether you do it in a week, in a month, or it takes you 10 years. Either way, you're gonna get the same result. Statistically speaking, every 3 people you see, one is gonna have some money, like about 30,000 on the average. They're gonna have it sitting around, they're gonna have it in a bank account, they're gonna have it in a CD where they're making nothing on it, and you're gonna show them how to take that and put it somewhere where they make substantially more on that money. Out of 32 people you see, all of a sudden, one you're going to come across out of the 32 that's going to be like, wow, I've got $500,000 sitting over here. I've got $1 million sitting over here. I know a good friend of mine that has a bunch of money. They don't know what to do with it. They've got it in a checking account. They've got it in a savings account. They're making zero and they are dying for somebody to show them. You understand? You understand what I'm talking about? So first thing you have to think about is I got to get my securities license. Second thing you got to think about is I'm going to get my feet wet. I'm going to talk about one client per week. Let me stop sharing this so y'all can look at me because I'm about to wrap up here. Okay, one client a week where they're just putting in some money into their retirement plan and they have no money. They don't have 30,000. They don't have 300,000. They got nothing. They're just getting started. Right? Maybe they're starting later in life, doesn't matter, right? It's better late than never, or maybe they're a younger family and now you're going to get them going, you're going to get them started so they can have a ton of money down the line. But either way, so start with that. Start with $25 investments and $50 investments and work your way up to teaching families how to maximize their IRAs. Maybe you're going to get 2 clients a week. Maybe you're going to get 3 clients a week. Maybe one client's going to maximize their IRA and one's going to do half the amount. They're not going to do the full 1,000 in their household. They're only going to do 250 and 250, which is total 500. In any case, it's going to start to add up. That gives you confidence. You're going to start doing that stuff in your sleep. Then, as you see these clients, all of a sudden, your third client, remember 1 out of 3, your third client is going to say, you know what, by the way, I've got an old 401k. There's not a lot of money in there. You go, well, how much is, I don't know, about 50,000. Inside, you're going to go, what? 50,000? Right? And on the outside, you go, yeah, great. Hey, listen, I'll show you how to roll that money over. Not a problem. Maybe they have 5,000, maybe they have 3,000, maybe they have 10,000. It doesn't matter. 1 out of 3. And then all of a sudden, you put your head down. You're helping people invest monthly. You're helping some of those people that have more money move their money over. It's called rolling that money or rollover. And then once in a while, you're going to come across a big whale of a client, somebody with hundreds of thousands. And because you've paid your dues, because you've gained your confidence, because you've talked to people and you understand the psychology of what it takes for somebody to invest, then you're going to have no problem. So when you see people, we have people in our own hierarchy that every month they do 500,000, a million, 800,000, 700,000. It's because they've done it for a while now, and they have the confidence to ask to, look around to see what monies are laying around in different places where the client's making no money. And then they have the know-how and the knowledge, and that comes with time. Are y'all with me on this? All right, listen, I'm gonna again try to keep these short and sweet. I hope that helps. Man, I am so excited. We're gonna keep doing these. So remember, these are gonna be every Tuesday, Wednesday, and Thursday. Tuesday, we're gonna have another guest speaker. I'm not gonna tell you who. Well, you know who. It's Patty's gonna come back, and she's gonna do a deep dive a little bit more into one of the products on the client solution side, and teach us more on how to market it and how we already talked about the commissions of it. Now we're going to talk about more of a deep dive on how to sell the product, how to market the product, how to talk about the product. So Tuesday, we're going to have our guest speaker. Again, next Wednesday, we're going to talk about other things. Thursday, we're going to talk. So every week, we're going to have Tuesday, Wednesday, Thursday, 8 a.m. Pacific time. You don't want to miss these. Also, we've already started posting these on YouTube. If you haven't gotten the link, talk to your RVP or text me directly, call me directly, call my office manager, and we'll make sure that you get these links. And then also, as you recruit people and you want to show them and teach them how commissions work in different products, instead of spending hours and hours and hours, you can send them the link, the appropriate link, the proper episode, and then you could talk to them. I say, hey, watch this first, and then you and I can sit down and spend as much time as you want and answer any questions you have and do a deeper dive. All right. I love y'all. I'm excited. Let's rock and roll, and I'll see you guys at the top. Bye-bye.